Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Marvell Technology.
If you find our talks useful, please consider subscribe, like, and comment underneath. So I want you to try and picture something for a second. Imagine you're building the most powerful, most highly tuned V8 engine in human history.
Okay, a massive engine. Got it.
Right, but you're so focused on the engine that you completely forget to build a transmission for it.
Oh, that's a problem.
Yeah, exactly. You fire it up, it makes this massive amount of noise, it burns through fuel at just a terrifying rate, but the car doesn't move an inch because the power never actually reaches the wheels.
Right, it's just revving in place.
Exactly.
Yeah.
And that is the exact physical bottleneck that the entire artificial intelligence industry is like slamming into right now in April of 2026. So today, we are unpacking the company that's essentially stepping in to build the drive shaft.
Yeah, and it really is a profound structural problem for the whole tech sector right now. And what's fascinating is that the company capitalizing on this, Marvell, they've undergone this complete metamorphosis recently.
Because they weren't always an AI infrastructure play, right?
No, at all. I mean, Marvell Technology used to be basically synonymous with somewhat, unglamorous, low-margin legacy storage controllers.
It's like the chips managing basic hard drives.
Exactly. Just standard commodity hardware. But they have aggressively repositioned themselves over the last few years. They stripped away all that legacy drag and transformed into an absolute powerhouse in AI data infrastructure.
A transformation that basically has the entire financial world treating them as this premier AI play. I mean, we are talking about a stock that recently secured a massive $2 billion strategic investment from the absolute biggest apex predator in the space.
Nvidia,
yeah. And that capital injection, combined with some just staggering forward guidance that we'll get into, has propelled Marvell to a really rare 9 out of 10 bullish investment score.
which is huge.
It is. But before we actually get into the financial mechanics of that guidance and the 2028 numbers, I really want to unpack the physical reality of this technology for you. Like, why is a company that's known for storage suddenly the critical transmission for NVIDIA's engine?
Well, to understand that, you have to really look at the physical architecture of a modern AI data center. Because when you visualize artificial intelligence, you probably just picture the software.
Right, like a chatbot or an image generator on your phone.
Exactly. Or maybe you picture like a single, incredible, powerful graphics processing unit, a GPU, just crunching the math in a lab somewhere.
Yeah.
But training a modern trillion-parameter large language model, you can't do that on one chip.
Right, it requires tens of thousands of these massive GPUs.
Tens of thousands, clustered together in these sprawling warehouses that literally span the size of multiple football fields.
Because the parallel processing relies on splitting that computational load across the entire facility, right?
Precisely. You have to divide and conquer. And that creates a massive logistical nightmare. Because as these AI clusters scale up and get bigger and bigger, the individual processors are no longer the actual bottleneck.
Wait, so the chips themselves aren't the holdup anymore?
No, the network itself becomes the latency bottleneck. Think about it. When chip A on one side of this massive data center needs to instantly share its calculations with chip B on the total opposite side, traditionally it uses copper wiring.
Which is the standard for basically everything.
Very standard, yeah. But copper has physical limits. When you try to push that much data across copper at those speeds, it generates an immense amount of heat. And worse, the signal actually degrades over distance.
Which introduces latency. And I imagine in a system where, thousands of chicks need to synchronize their math in real time, even a microsecond of latency probably compounds into a massive drop in efficiency.
It absolutely tanks the total system efficiency. The engine is revving, to use your analogy, but the wheels aren't turning fast enough.
So that is where Marvell's specific technological moat comes into play, right?
Right. They have gone all in on high-margin custom silicon. The industry calls them XPUs. And more importantly, they've gone all in on advanced electro-optics.
Electro-optics, let's break that down.
So they specialize in building these high-speed optical interconnects that completely replace that legacy copper wiring. Their hardware literally translates the electrical signals coming out of the GPU into tiny pulses of light.
Oh, wow.
Yeah, it fires that light across the data center through fiber optics and then translates it back into an electrical signal on the other end.
So they are sending data literally at the speed of light, which virtually eliminates the heat and the latency issues you mentioned.
Exactly. It allows tens of thousands of disparate, spread-out chips to basically function as one single unified supercomputer.
Mm.
And honestly, that specific capability is exactly why we saw that landmark $2 billion strategic investment directly from Nvidia earlier this year.
Right, and a $2 billion cash injection is a massive headline. But, as an investor looking at this, I really want to know the structural impact of a move like that. I mean, Nvidia doesn't just hand out billions of dollars in capital without highly calculated reason.
Oh, absolutely not. They are ruthlessly strategic.
So what does that specific alliance actually do to Marvell's competitive landscape?
It effectively creates a quasi-duopoly in the AI infrastructure space. By aligning themselves this closely with Nvidia, Marvell heavily de-risks its own future.
How so?
Because Nvidia is recognizing a glaring supply chain vulnerability on their end. They know they cannot sell their massive super high-margin GPU clusters to the hyperscalers, the Googles and Amazons of the world, if the network infrastructure isn't there to actually support it.
Oh, I see. So that $2 billion is essentially Nvidia securing their own supply chain.
Exactly. They're ensuring Marvell has the immense capital expenditures required to scale their electro-optics production right alongside Nvidia's own GPU roadmap.
They're locking up the transmission supplier to make absolutely sure their engines can actually be deployed when they sell them.
You nailed it. It's a brilliant strategic moat for both of them.
It is. But a great narrative and a strong moat, they only really matter to your portfolio if they actually translate into hard earnings.
Right. Show me the money.
Exactly. So let's dig into the fundamental shift in their revenue trajectory, because the numbers are wild.
They really are. That structural pivot away from legacy storage and into high-margin custom silicon, it is showing up violently in their fundamentals. Just look at their fiscal Q4 2026 earnings report.
Okay, let's look at the top line first.
Top-line revenue hit $2.22 billion. That delivered a 7.5% beat over the Wall Street consensus estimates.
Which is a solid beat, but the aggregate revenue only tells half the story here, right? The composition of that revenue is what's really justifying all this massive institutional focus right now.
The internal mix is literally everything in this report. The data center segment alone pulled in roughly $1.5 billion for the quarter.
Wait, $1.5 billion just from the data center infrastructure?
Just from that one division. It is no longer just some speculative growth segment for them. It has completely eclipsed the legacy business to become the undisputed engine of their entire financial model.
And because custom AI silicon and those electro-optics command premium pricing compared to, commodity storage controllers, I'm guessing we are seeing some aggressive margin expansion too.
Oh, big time. We saw adjusted earnings per share come in at 80 cents, which was an 8.3% beat.
Okay, so the operating leverage is clearly there, which is crucial. But I think the real shockwave from that report came from management's forward guidance.
Yeah, the guidance was stunning. They're projecting fiscal 2027 revenue to approach $11 billion.
$11 billion. That represents, what, over 30% annualized growth?
Yes, over 30%.
I mean, a 30% CIGR at an $11 billion scale is incredibly difficult to achieve, let alone sustain for a hardware company.
And they didn't even stop there. They laid out a roadmap for fiscal 2028, projecting a staggering $15 billion in revenue.
15 billion.
Yeah, and just to contextualize how aggressive that is, the broader Wall Street consensus for 2028 was sitting at $12.92 billion before this.
So management just fundamentally blew past the street's models.
Utterly destroyed them. And they're attributing this explosive multi-year growth runway to this phenomenon that's being labeled the inference supercycle.
Okay, so I need to play devil's advocate here for a second.
Go for it.
Because Wall Street is absolutely notorious for inventing buzzwords to justify inflated valuations, right? We have heard about the AI training boom nonstop for the last 3 years. The entire narrative has been hyperscalers buying up chips to build these foundational large language models.
Right, the training phase.
Yeah, but now analysts are suddenly pivoting to this new buzzword, the inference supercycle. So I have to ask, is this just a marketing pivot to keep the stock price pumping, or is there tangible, actual mechanical proof that this demand is shifting?
It's a fair question. A healthy dose of skepticism is absolutely required anytime you hear the word supercycle from a bank. But the mechanics of inference versus training, they dictate two entirely different cycles of capital expenditure.
Okay, walk me through the difference.
Think of training an AI model like putting a student through a highly specialized medical school.
Okay.
It takes years, it requires an immense concentration of resources, and it costs an absolute fortune up front. But you only do it once to create that specific baseline of intelligence.
Right. And that initial heavy lift phase is what drove those massive GPU shortages we saw over the last few years.
Exactly. That was the medical school phase. Inference, however, is that trained doctor actually entering the hospital and diagnosing hundreds of patients every single day for the rest of their career.
Oh, what?
Inference is the deployment phase. It's when the AI model is finally pushed out to edge data centers globally, and it's actively processing queries, generating code, or, analyzing video for millions of end users simultaneously.
I get that, but why does that trigger a totally new hardware cycle for Marvell? Like, why can't the cloud providers just use the existing hardware they already bought for the training phase?
Because using a massive, incredibly power-hungry training GPU to run a simple daily inference query is wildly inefficient. It is like using a sledgehammer to drive a thumbtack.
Oh, I see. Just overkill.
Complete overkill.
Mm.
The power draw alone would bankrupt the cloud providers if they did that at scale. To monetize AI cost-effectively for millions of global users, hyperscalers require highly efficient custom accelerators.
They need application-specific integrated circuits.
Exactly, which happens to be Marvell's custom XPU specialty.
Okay, that makes a lot of sense. So if training was the multi-billion-dollar setup phase, inference is the multi-decade monetization phase. And the hardware requirements are fundamentally shifting away from raw brute force to favor, efficient custom networking and silicon.
Exactly. And to address your skepticism about whether this demand is real or just a convenient narrative, you really just have to look at the backlog data.
The order backlog.
Yeah, there are very credible industry reports circulating right now, pointing to a $75 billion pipeline for AI XPUs.
Wait, $75 billion? Just for the custom silicon pipeline?
Yes,
Okay.
across the industry. And if a hyperscaler backlog, even remotely approaching that size, actually exists, it suggests the total addressable market is vastly larger than even Marvell's aggressive $15 billion guidance implies.
Wow. So it proves that major cloud providers, the Microsofts, Amazons, Googles of the world, they are placing hard contracted orders for this custom silicon right now to prepare for that global inference deployment.
Exactly. It's not hype. It's contracted capital.
So, okay, with guidance that is fundamentally crushing consensus and a really tangible pipeline validating the supercycle thesis, it makes total sense that the market is reacting aggressively. I mean, a stock doesn't achieve a 9 out of 10 bullish score quietly.
Definitely not.
How are institutions mechanically trading this breakout right now in mid-April?
The institutional accumulation we're seeing is textbook. If you look at the price action, the stock surged 21.3% in March alone.
21% in a single month for a large cap is massive.
It is. It climbed from $83 back in January to near $119 by April 9th.
Which is sitting right near its absolute 52-week high of, 127.48.
Right. And pushing up against all-time highs on heavy volume, that is the ultimate signal of institutional conviction.
Right, because it means portfolio managers are not looking at a 40% year-to-date gain and just taking profits.
Exactly. They are actively adding to their positions at the very top of the range. And a major catalyst for that continued accumulation hit right on April 9th when Barclays officially raised the stock to an overweight rating.
And when a Tier 1 bank like Barclays upgrades to overweight, it triggers a very mechanical wave of buying, right?
Highly mechanical. Institutional portfolio managers who track the semiconductor index, they're essentially being told by these banks that they need to hold a larger percentage of Marvell than the benchmark actually dictates.
Right. So if they are underweight based on the new rating, they're basically forced to step in and buy just to rebalance their portfolios, which creates this sort of structural floor of demand under the stock.
Perfectly said. And we actually saw another major investment bank follow up right after by predicting a 25% upside jump from current levels.
Wow.
So the market has definitively repriced this company. It is no longer being traded as some legacy turnaround story. It is being traded as an undisputed high beta AI leader.
And the high beta nature of the stock right now is really fascinating to watch. When the broader semiconductor index catches a bid and starts moving up, Marvell doesn't just match the index, it moves with double the aggression.
It rips higher, yeah.
Right. Buyers are just swooping in to buy every intraday dip, which creates this really strong psychological, technical state of breakout confirmation. Every pullback is basically viewed purely as entry liquidity.
It is an incredibly bullish setup. But, we do have to stress test this thesis.
Right. Let's talk about the risks.
A stock moving with this much velocity and trading at these specific multiples is highly vulnerable to the broader macroeconomic environment. We absolutely have to look at the bear case here.
Well, the valuation is the obvious starting point for the bear case. Following this huge institutional run-up, Marvell is currently trading at a trailing price-to-earnings ratio of roughly 29x
Yep.
and a forward PE of roughly 24x based on the consensus earnings.
And a 24x forward multiple means investors are paying a very steep premium today for those $15 billion in revenue that are promised for fiscal 2028.
Right, you're paying for years of flawless execution up front.
Exactly. High multiples leave absolutely zero room for execution errors.
So if management misses a single product delivery deadline for these new XPUs, or if, say, a major hyperscaler decides to delay their data center build-out by just one quarter,
The market will instantly punish that multiple. We call that multiple contraction, and it can be incredibly violent. Well, even if the company continues to actually grow its revenue, if the growth rate decelerates even slightly, the market might suddenly decide it's only willing to pay 18 times forward earnings instead of 24 times.
meaning the stock price completely collapses, even while the underlying business is technically still growing.
Exactly. It's a brutal re-rating process.
And that multiple contraction risk is amplified immensely by the current macro environment, right? I mean, we just saw the Dow Jones and the broader indices take a severe hit following back-to-back hot inflation prints.
Persistent inflation is the mortal enemy of high-growth tech valuations. There's just no way around it. If inflation remains sticky above the Federal Reserve's target, the Fed is structurally forced to hold interest rates higher for longer.
And this is where the cold math of valuation becomes really ruthless. Because if the risk-free rate, like the 10-year Treasury yield, stays elevated because the Fed simply can't cut rates, the discount rate applied to future corporate earnings goes up.
Right.
That mathematically makes Marvell's massive 2028 projected profits worth significantly less in today's dollars.
Which traditionally triggers a mass exodus out of high-beta tech stocks.
So I really have to challenge the core thesis here then.
Yeah.
If inflation stays hot and the Fed flat out refuses to cut rates, a 24x forward multiple feels incredibly heavy for a company whose core business ultimately relies on hardware manufacturing and physical supply chains.
It does.
Right, because hardware historically gets hit the absolute hardest when capital gets expensive. So what protects the downside here? If the macro environment turns truly hostile this year, what stops the stock from sliding right back down to $80?
It is the defining debate among institutional investors right now. Question is, can a secular generational tech trend completely outrun a hostile macroeconomic environment?
Right. Can the AI supercycle just ignore the Federal Reserve?
Well, the market is currently betting billions of dollars that it can.
Really?
Yes. The downside protection, that tangible fundamental floor that's keeping the multiple intact right now, it all comes back to the absolute certainty of the hyperscaler demand we talked about earlier.
Because the AI arms race is basically an existential threat to the mega cap tech companies.
Exactly. Microsoft, Google, Amazon, they are not going to halt their multi-billion-dollar data center expansions just because the Federal Reserve holds interest rates steady for another 6 months.
Right, because the stakes are too high.
Way too high. If one of them pauses their infrastructure spend just to save on near-term capital costs, they risk losing the AI dominance race entirely.
Yeah.
Which would completely devastate their trillion-dollar market caps.
So they are essentially forced buyers of Marvell's infrastructure, regardless of the broader macro conditions.
Yes. So that $11 billion near-term revenue guidance is basically viewed by Wall Street as locked-in contracted capital.
Which triggers a really fascinating paradigm shift in how people invest, honestly.
It really does. In a volatile macro environment where, consumer spending is highly uncertain and industrial production is lagging, portfolio managers are desperately hunting for guaranteed earnings growth anywhere they can find it. So they are currently utilizing elite, deeply entrenched infrastructure, plays like Marvell almost as a safe haven.
All right. Treating a 24x multiple hardware stock as a safe haven is wild. I mean, you typically reserve that status for utilities or consumer staples, right? Like toothpaste and electricity?
Normally, yes. But you are seeing the sector-specific tailwinds of this inference supercycle being so powerful that they are actively overriding traditional macroeconomic gravity.
Wow. So when you combine that deeply contracted hyperscaler backlog with the $2 billion strategic cash buffer provided by Nvidia, You create a fundamental floor that makes institutional sellers very, very hesitant to take profits, even when inflation prints run hot.
That's exactly the dynamic playing out right now.
Okay, so knowing that the secular momentum is currently kind of battling against these macro headwinds, what are the specific mechanical triggers that you need to watch in the coming months to actually validate that you should stay in this trade?
The catalyst calendar is highly concentrated. You don't have to wait long. The most critical event by far is the release of their Q1 fiscal 2027 earnings report.
And that's coming up soon, right?
Yeah, that will land in late May or early June.
Okay, so when you inevitably pull up that earnings transcript, what is the exact metric or phrasing that dictates whether this bullish thesis actually holds?
You are looking for absolute, unwavering confirmation of the $15 billion fiscal 2028 roadmap.
They can't walk that back at all.
Not even an inch. Management needs to reiterate that exact figure or ideally raise it based on new XPU contracts.
Mm.
If there's any hesitation or, if they cite supply chain constraints limiting their ability to hit that target, the multiple will contract sharply.
That makes sense. Any other near-term catalysts?
Additionally, you really want to monitor the upcoming AI industry summits over the summer. Marvell frequently uses these events to showcase new custom silicon collaborations with Nvidia.
Oh, right, maintaining the narrative.
Exactly. Those announcements serve as highly effective short-term catalysts to maintain that institutional momentum and keep the buyers engaged.
Well, when you synthesize all of these moving parts together, it becomes pretty clear why Marvell Technology commands that 9 out of 10 bullish score.
It really is a unique setup.
It is. I mean, they have successfully executed one of the most difficult maneuvers in the entire tech sector. They pivoted away from a stagnant, boring legacy business to become the critical nervous system of a generational technological shift.
Right.
They have that massive $2 billion war chest from the industry's apex predator, Nvidia, and they're projecting hypergrowth straight through to 2028. So, when you are looking at your own portfolio, this really represents a highly compelling multi-year hold that offers just a very rare combination of deep infrastructure necessity and really aggressive price momentum.
Yeah, it is the ultimate pick and shovel play of the artificial intelligence era.
Yeah.
The shovels happen to be built out of custom silicon and electro-optics.
I love that analogy. Well, I want to leave you with one final provocative thought to ponder as you watch this space evolve over the next few years.
Let's hear it.
We have spent this entire discussion focusing on the relationship between the brains of the AI operation and the nervous system. But if the physical network fetches, the literal ability to push data fast enough without melting the facility is actually becoming the ultimate bottleneck for global computing. Is it possible that the infrastructure companies building the nervous system will eventually command higher margins and perhaps become even more mission critical than the companies building the brains?